Is the U.S. economy on the brink of collapse? It's a question that has been echoing through the financial world recently. With the International Monetary Fund downgrading its economic growth forecast and recent financial turmoil stirring up the waters, there's an air of uncertainty that's hard to ignore. The United States, a global economic powerhouse, is showing signs that could be interpreted as precursors to a downturn. But is it really a cause for alarm or just part of the economic ebb and flow? In order to understand the answer, we must first delve into the past. History often repeats itself, but how closely does our current situation mirror past economic crashes? Let's delve into a brief journey through time to understand this better. The Great Depression, the economic crash of the late 20s, was marked by a banking collapse triggered by a speculative bubble. Fast forward to today, and we see the collapse of regional banks, a potential warning sign. Back then, the bubble burst led to a decade-long economic downturn. Though we have evolved significantly since then, the fundamental structure of our financial system remains largely the same. Now consider the stagflation of the 70s, a period characterized by high inflation and stagnant demand. Today we face similar inflationary pressures. The 70s taught us that unchecked inflation can wreak havoc on an economy, leading to unemployment and slow economic growth. Let's also look across continents to the recent Sudanese revolution in 2019. A country that cast off despotic rule now teeters on the brink of collapse due to power struggles and leadership challenges. While the U.S. has a more robust political system, this example serves as a stark reminder of how economic instability can fuel political unrest and societal discord. And then we have the Great Recession of 2008, a crisis triggered by a housing market crash and risky banking practices. As we navigate today's volatile financial landscape, echoes of that period resonate. The banking system's strength is again in question, and the potential for another recession looms. However, it's crucial to note the differences as well. Today, we have more advanced financial tools and regulatory measures to mitigate such crises. Our economy is more diversified, and we have a better understanding of economic indicators and trends. While history doesn't repeat, it often rhymes. So what does the future hold for the U.S. economy? Stay tuned as we explore the devaluation of the dollar and the potential implications of an economic collapse. One key indicator of economic health is the strength of national currency. In the last 50 years, the value of the U.S. dollar has seen a significant shift. In the mid-70s, a dollar could buy you a gallon of gas, a movie ticket, or a decent meal at a diner. Fast forward to today, and it's a different story. Those same items now cost several times more. This isn't just inflation at work, it's the devaluation of the dollar. The dollar's value is not an isolated concern. It's linked to many factors, including the strength of the American economy, the country's debt levels, and the global demand for dollars. Over the past 5 decades, we've seen an increase in national debt, fluctuating economic stability, and a shifting global economic landscape. These factors have contributed to the dollar's devaluation. Experts have often compared the dollar's journey to a roller coaster ride. There have been periods of strength, like in the early 80s and late 90s, but also periods of weakness. The most significant dip in the dollar's value occurred in the late 70s due to rising inflation and a lack of faith in the American economy. Looking ahead to the next 50 years, it's challenging to predict the dollar's trajectory. Economic forecasts are complex and uncertain. However, if current trends continue, we could see further devaluation. This could be driven by increasing national debt, potential economic instability, and shifts in the global economic power balance. This isn't just an abstract economic issue. The value of the dollar affects everyone, from the price of groceries to the cost of a college education. It impacts international trade, influences global commodity prices, and can even affect geopolitical relationships. A falling dollar can have far-reaching implications, not only for the U.S., but for the global economy. So what happens if the U.S. economy does collapse? The consequences could be far-reaching. A collapse of the U.S. economy would likely send shockwaves through the global financial system. As the world's largest economy, any significant disruption in the U.S. could trigger financial instability worldwide. We've seen this before, during the 2008 financial crisis, for instance, when the collapse of major U.S. financial institutions led to a global economic downturn. Consumer spending, a key driver of the U.S. economy, could take a significant hit. In times of economic uncertainty, consumers tend to tighten their belts, reducing spending on everything from luxury goods to everyday necessities. This in turn would likely lead to job losses in sectors heavily dependent on consumer demand. The housing market, too, could be severely affected. A sharp decrease in consumer confidence often leads to a drop in housing prices, as we saw during the 2008 recession. This could make it even more challenging for younger Americans to buy homes, exacerbating the already significant generational wealth gap. And what about the burgeoning crypto industry? Well, it's tough to say. On one hand, economic instability might lead some to invest in cryptocurrencies as a hedge against traditional financial markets. On the other, a collapse could lead to a tightening of regulations and increased scrutiny of the crypto industry, further complicating its future. In the face of such potential chaos, it's important to remember that these are just possible outcomes. The resilience and adaptability of the U.S. economy have been tested time and again, and each crisis has brought with it opportunities for growth and innovation. While the future is uncertain, understanding these potential outcomes can help us better prepare for what might come next.